This is the strongest stock market rally we've ever seen in history. I mean, come on, the last 2 years have seen a 60% increase. And the only conclusion I can come up with is we are straight And I know what you're thinking. You're thinking, how can that be? The last 2 years, 60%? We are in the strongest stock market rally we've ever had in history. And that is exactly why it's all gonna come crumbling down. Because if you look at the other periods of time that have followed the exact same patterns, well, let me just give them to you. Let's compare to historical growth that matches what we're at today. You'd have to go back to 1965 to 1985. It took 20 years to get similar returns to what we're at today. But then in 1996 to 2011, it was a 15-year period to get similar returns. And then 1987, 1996, 2011, and 21 to 25 all saw similar patterns of growth. But every one of those were followed by a large market correction. 3 out of the 4 times, all of them were followed by large market corrections. But here's the real kicker. Every one of those periods of time involved high inflation, just like we just finished. High inflation followed by large market corrections. So in today's video, we're gonna talk about the disconnect. The disconnect between the strong stock market and the economic struggles we're going through. And not only that, Mr. Warren Buffett. We're gonna talk about what he's doing and why you should be taking some notes. My name's Chris Naugle. This is What Now? What's next for this whole thing? So I want you to think about the current environment, kind of like the game Jenga. You know, in Jenga, you keep building the thing higher and higher and higher, and the higher it gets, the more unstable it gets, and it's just one block away from crashing down. You know exactly what I'm talking about. That's the disconnect. We are so focused on the build and the height and the growth and, oh my gosh, everything that's going on that you see in the news, that we are ignoring the telltale signs, the signs that point us to other periods of time in history where the exact same thing has happened, and it always leads to the exact same place. So let's dive into the disconnect, because here it is. All-time record highs in the stock market, but yet the average American, 30% of Americans are living paycheck to paycheck. Credit card debt, all-time highs, peaking $1.2 trillion. That's a first. And there's no excuse other than everything is a game of smoke and mirrors right now. What you're seeing, the unemployment numbers, what you're seeing, the retail sales going up, what you're seeing from the corporate profits being blockbuster and knocking it out of the park is all a sign of it's gonna end. Jenga is gonna tumble. How about consumer sentiment? Like how people feel about everything that's going on is at one of the lowest periods of time in history. As a matter of fact, the records, the statistics show that it's matching that of the 2008 Great Recession. Kind of funny how that works. We're also gonna talk about Mr. Warren Buffett and his $325 billion cash position. But you know, that doesn't really put it into perspective, but this should. His portfolio consists of 30% in cash. Do you know what that means? Like, Warren Buffett is not a cash guy. Warren Buffett is an investment guy, a long hold guy, a stock guy. So obviously he can't find anything to put his cash to work at, or he sees a really big opportunity coming. Rent prices right now are contracting for the first time since the Great Recession, and they are predicted to continue to contract. So what is going on? How can one side look so good and the other side look like it's a diseased rat? So the wealth from the real economy is flowing into financial assets, and it's happening at an unprecedented pace. Not only that, corporate profits, okay? You're seeing corporate profits come out and blockbuster earnings and everything else. Every time there's an earnings report, you see it. This company and that company and this company blows out estimates. But what is that really telling you? Well, you can connect that back to one thing. Inflation. So you could make the argument that profits and real inflation are directly connected. They're linked, connected at the hip. Corporate profits right now make up 13% of the entire GDP, which is the highest in history. The simplest way to say it is that the economy is just diseased. It's diseased with debt, it's diseased with inequality, and it's pretty much straight up. So in a perfect world, all the money from those corporate profits that are coming out blockbuster, that would flow back into the economy, right? But it's not. Pay attention and look at what's going on. Corporate profits are just going into financial assets, which are not benefiting the overall economy, which is why the economy is having a hard time growing, which is why the economy is literally shrinking. It should be doing the complete opposite, but you can see we have a little bit of a problem here. Have you ever heard of a company called BlackRock? You ever heard of Blackstone, Vanguard? Yeah, those are the ones who are benefiting. Matter of fact, I saw something not long ago, and you can check this article out right here. BlackRock pretty much owns everything right now. So what's happening in the economy is clearly disproportionate. Just look at the cost of living right now. Look at corporate greed. The US is seeing a massive split in income inequality, the rich and the ultra wealthy. It's making it difficult to prepare for what's next, but I gotta ask you, what is next? Well, if we're thinking of what's next, it's probably best to look at one of the best investors of our time, none other than Warren Buffett. And while he's still alive, we really need to learn from the way he invests and what he does. Now, I know there's a lot of people that have read his books, and I know there's a lot of people that follow what he's doing, but the main problem is nobody's paying attention. Like I mentioned before, Warren Buffett's Berkshire Hathaway is sitting on record cash hoards, $325 billion. 30% of its entire allocation is to cash. To put that into perspective, Berkshire Hathaway over the last 30 years has returned roughly 2,100%, where the S&P 500 is returned 800%. Now, I'm not saying 800 is bad, but 2,100 is exceptional. And you don't make 2,100% investing in cash, putting money in cash. So where is the disconnect, Mr. Buffett? Warren Buffett has been accumulating cash at unprecedented levels since 2012. So what is he trying to signal? Is he signaling that we're looking down the barrel of a recession? Is he saying that we're going to see some major corrections, which to him are buying opportunities? I mean, Warren Buffett does not rely on macroeconomic predictions to make his decisions. So what is it that we are missing that he isn't? Or does he have it all wrong? Well, if we go back into history and we look at Warren Buffett's last little cohort where he piled up cash, it would have been right before the Great Recession. And does anyone remember that? No, because the news wasn't covering him hoarding cash. The news definitely covered him buying like a crazy drunken sailor after the 2008 recession, because he bought everything. He went after railroads. He just started buying things because they were pennies on the dollar. And that's how he's gotten this wealthy, and that is how he has had 3 decades of returns like what we talked about. Because it doesn't come with just guessing. It comes with doing it the right way. Because he understands the way to make money in the market is to buy low, sell high, and don't lose money. But you see, the majority of the folks out there piling money into the market are doing the complete opposite. They're buying high, and they will more than likely sell low, and they will definitely lose money. And that isn't going to be any of you watching this video, if you get ready. But the good news is that's not going to be any of you because you're watching this video and you probably watched the other videos. But if this is your first time, well, let's get to it. Hit the subscribe button and there's a little bell up top. What I'd love you to do is smash that bell. You can hit it with a left hook, a right hook. Hell, you can even headbutt it. That was weak. I've never been a headbutter. Are you a headbutter? Are you a bite? Oh, you're a biter? Oh, shame on you. Anyway, let's get back into this. So our markets are manipulated, they are overpriced, and they are clearly unstable. And I think that's what Warren Buffett's doing. He's saying, Jenga. I think he's literally telling you and telling all of us that there is a major market correction coming. I mean, what else could it mean? Is he literally just piling money into cash because he's being paid to be in cash? Oh, let me hit that real quick. Maybe Warren Buffett just likes the yields on cash right now, because I mean, you should like it as well. Right now, you can get paid for sitting on the sidelines. There hasn't been another period of time in a long time where you're literally paid this kind of yield for sitting on the sideline. High yield savings accounts, specially designed whole life, treasury bills, CDs, money markets, all of them are paying a really, really good guaranteed or almost guaranteed return on your money. Warren Buffett knows that. Why take the risk to be in the market when it's overbought, unstable, and just stupid when I can sit on the sidelines in practically guaranteed accounts making 4 to 5%? Wouldn't that make sense? I mean, isn't that what all of you are thinking? It is, right? You're like, well, why would I go in the market and take the risk when, but that isn't, because I talk to people over and over and over again, and I ask them, why are you still in the market? And it's FOMO, folks. It's FOMO, fear of missing out. They're afraid that the markets are going to move higher and they're going to miss out. And I say to them, I said, yes, but what are you really going to miss out on? Oh, I don't know, I'm going to miss out on 5 or 10%. And in one day, if Black Monday were to happen again, you could lose 30% in a day. You could lose 20% in a week. You could lose any amount of money that will be far more than what you have the potential to make. So is the juice worth the squeeze? That's my question. Is it? I love me some good orange juice, but sometimes the squeeze is not worth the juice. Comprende? So let's talk about what I like to call the expensive market, the stock market, because it is. It's super expensive. It'd be like walking into Walmart and the exact opposite of rollback happens. They roll up and then they roll up again and again and again. And literally you're just overpaying for everything. Why? Because you're afraid that the toy's not going to be there tomorrow. You'll pay anything for it. But that toy is a stock. And maybe that stock is Nvidia, is Apple, is Google, or any of the other magnificent 7 or 8s, because I think there's 8 of them now. So I found this article, and I think you'll like it right here. The S&P 500 hits all-time highs, up over 65% from the 2022 lows. So when we're thinking about the S&P 500, we got to look at PE ratios and look at where they're at. Well, they are currently at historically high levels, signaling that the stocks are overpriced relative to earnings. Warren Buffett has consistently used this ratio as a signal. He's talked about it in all of his books. And he also uses it to reduce exposure to stocks when they are expensive. Ding, 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 right now. He's currently holding less stock relative to his overall portfolio than he ever has in history. That should wake you up a little bit. And I know someone out there is like, oh, well, this stock's different. No. Every sector is overpriced right now. Every sector. So let's make a case for cash. Because I mean, Warren Buffett's loading up on it, so let's figure out why. Well, I talked about it earlier, but Buffett's strategy isn't just about predicting a recession. He doesn't time the market. He never has, and he probably never will. But what Warren Buffett does is avoid overpaying for stocks. He doesn't want to buy high. He wants to buy, put it in the comments, low. That's right. So his cash to equity ratio is now at its highest level in decades. His cash to equity ratio is now at its highest level in decades. And he's holding on to cash because stock prices are too high for him to buy. And the yield on cash, like I mentioned earlier, is the highest it's been in 30 freaking years. That makes it a really attractive alternative to investing in stocks. So why would you buy low and sell high when you can buy high and sell low? Did you catch that? See how I just did that? I threw that in there just to see if I could spin you up a little bit. No, you want to buy low and sell high. You don't want to buy high and sell low. But emotion, for most people, will get the best of them. That's what FOMO does, and that's what emotion does on the other side, because fear is a magical 4-lettered beast. And once the markets let loose, and once they start going down, Warren Buffett will be buying, and unfortunately, so many of the people out there will be selling. So Warren will have no trouble finding things to buy, and neither will you. Because if you're listening to what's going on here, you're gonna hopefully load up as well. So what is the risk of a market correction, and what could trigger it? Well, I wrote down a couple things here. So historically, when cash yields rise higher than stock market returns, well, the market becomes vulnerable to a correction. So let's put that into context. Right now, you can get right around 5% on cash, give or take. And how much can you get on stocks? So when we look at stocks, we're looking at dividends right around 3%. So now let me ask you, are the cash yields higher than the stock market returns for holding? Well, Warren Buffett would say yeah. You see, they call it a negative spread. And a negative spread is where cash yields are more than stock market yields. And this has occurred several times, and the times that it has, it's resulted in a significant market drop, i.e. 1987. And do you know what happened in 1987? The Black Monday crash. The market is currently experiencing this negative spread right now. Not only that, and in a bunch of videos, and even recently, I've talked about the inverted yield curve and its relevance in the markets and how every time it's happened in the past, it's resulted in a recession. But I also talked about how it re-inverted. And I talked about how every time it's re-inverted, the market did go into a recessionary period. So what is all this saying? Well, it's basically saying that investors are less likely to allocate money to stocks based on this info, but what investors? Well, investors like you, investors like Warren Buffett, investors like Bezos and Zuckerberg, and all the big ones like Burry and so many of the hedge fund managers, they are paying attention, while the rest of us are not. And because of that, you're raising the risk of a market downturn. So in conclusion, when we look at this as a long-term outlook, I think what we can conclude is that the stock market can and may continue its bull run for the short run. But the risks of a correction are rising as inflation, market manipulation, and market valuations, as well as wealth inequality, which is a real thing right now, all create an unstable financial environment long-term. Warren Buffett's cash strategy is nothing more than a defensive play. And all of the experienced investors out there are doing the same thing, myself included. So with a market that's both expensive, overpriced, and unstable, I think the best thing to do, and this is not investment advice, it's just wisdom, is to get out and also protect your capital, protect your principal. And a great way to do that is by you becoming your own bank. I mean, looking at specially designed and engineered whole life as a storage of wealth. I just did another video talking all about that. It works, and it will work for you as well. Are you prepared for market volatility? Should you be considering a more defensive financial strategy than what you're doing now? Stick around on this channel to learn the safest ways for you to take back control of your money, for you to be the bank. And with that all being said, my name's Chris Naugle. This has been another episode of What Now? What's next? We'll see you next time. And if you want to see that new video and the mathematics behind it, check that video out right here.